The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Well, a very warm welcome to Squawk Box Europe. I'm Steve Sedgwick with Karen Cho, Ben Boulos and Charlotte in Paris at the G7. I will just say to you, though, we just have a jobless rate of 5% in the United Kingdom. That is up from 4.9%. That is the numbers hitting the wires.
The EU Commissioner's Valdis Dombrovskis tells CNBC that Europe is facing a stagflationary shock, as French Finance Minister Roland Lescure says policymakers must send a clear message to markets.
We need to make sure that we reassure the bond markets on the fact that we are going to do everything we can to support growth without leaving public deficit go astray, because it's not the right way of doing it. This is a supply shock. We're not going to solve a supply shock by funding demand like there's no tomorrow.
Crude prices dip, but only a little bit. Look at that WTI, only down 0.2%, as President Trump says he has postponed a fresh attack on Iran and hints at progress in negotiations with Tehran.
We were getting ready to do a very major attack tomorrow. I put it off for a little while, hopefully maybe forever, but possibly for a little while, because we've had very big discussions with Iran.
Elon Musk loses his case against OpenAI, with a California jury ruling that the billionaire waited too long to sue the ChatGPT maker over claims it violated a deal to run the AI startup as a strictly charitable non-profit.
I will come back to that UK data in a few moments' time. But the French Finance Minister Roland Lescure has told CNBC, actually our very own Charlotte, the global economy is facing a supply shock as a result of the war in the Middle East, but added that any financial support must be targeted. Lescure, who chaired a meeting between G7 finance ministers in Paris this week, said it's important to understand the impact of the crisis on growth, on inflation, dare I say it, on wages, looking at UK data as well, and budget deficits before making any decisions. Well, Charlotte joins us now to tell us what she discovered from not only Lescure, but also Mr. Dombrovskis. Charlotte.
Yes, absolutely. All these policymakers meeting yesterday and this first day of this G7 finance minister and central bank governors meeting, of course, a particular context because of the war in Iran and the concerns around what this impact this could have on the economy. They said, look, in previous crises, we've seen some resilience in Europe. Of course, there's a concern that the worst is yet to come. And the latest chapter on this crisis, of course, was the bond sell-off that we saw yesterday, triggered by fears over inflation risk and, expecting that central bank governors might be raising interest rates sooner rather than later. So all this was very much in the mind of all these policymakers meeting yesterday. And we had a chance to sit down with the EU Economy Commissioner Valdis Dombrovskis, and we discussed about all this. Of course, the Commission is set to publish their spring economic forecast in a couple of days. So we didn't go into the specific numbers before that publication. But the Commissioner did tell us that they expect to downgrade the growth forecast for Europe. The previous forecast was a Europe growth of 1.4% this year, 1.2% for the Eurozone, with inflation around 2%. And now he expects to see an inflation that would be higher. All this because, of course, of the war in Iran. So I had a chance to sit down with the Commissioner and we discussed about the current situation.
European economy has shown resilience in face of this shock, to a large extent, thanks also to the lessons learned and investments done since 2022, when Russia invaded Ukraine and we had a previous energy price shock. So since then we had done a lot to diversify our energy flows, to reduce our dependencies on imported fossil fuels, to strengthen our energy connections, and so on and so forth. So that's all paying off now. But at the same time, yes, the impact is still felt. So in Europe we are facing a stagflationary shock. So later this week we'll be publishing the spring economic forecast, where, well, in a sense we'll be adjusting the economic growth figures down, whereas inflation figures up. So this was also one of the topics we were discussing. So what is appropriate policy response to this? And besides obviously addressing the root causes of conflict, we think it's important that the support measures we take are temporary and targeted, not the ones which are actually sustaining high demand for fossil fuels. And we also need to look at other value chains, so it's not limited to oil and gas, but also to derivative products, and also to other sectors like fertilizers, for example.
And that is the key concern now, I guess, that a lot of these European governments don't have the fiscal headroom that they had in previous crises. How is your conversation with the governments of France, of Italy, the ones I think are putting extra measures to, I guess, protect households and businesses? So what's their margin of action there, and how much are you telling them don't move too much?
Well, indeed, margin of action is more limited now than it was some years ago. Like during the COVID, we were doing a broad-based fiscal stimulus. But as a result, now we have elevated debt and deficit levels, and also interest rate environment is very different. Back then we had, broadly speaking, zero interest rates. Now interest rates are much higher. So fiscal space is more limited. That's why we argue for those temporary and targeted measures, also to limit fiscal cost. But also it's worth noting that if all countries will do broad-based measures and blunt the price signal, so to say, to sustain fossil fuel consumption, that will keep global prices up. And as a result, countries will be spending lots of money with a limited impact, because sustaining the demand, you will also sustain the high prices. So that's why it's important also to, in European Union in a case, to continue our moving away from dependencies on fossil fuels. And this was part of our Accelerate EU communication, where we outline also as part of our policy response that we need to accelerate the rollout of low carbon fuels in the EU.
And that was Valdis Dombrovskis, the EU Economy Commissioner, speaking to me from here this first day of the G7 meeting. Now today, of course, will be the second day of this meeting that is chaired by Roland Lescure, the French Economy and Finance Minister. And I had a chance to catch up with him as well at the end of yesterday, the very first day of that meeting. And he had quite a somber tone there after this day. He talked about a critical moment geopolitically, economically and financially, saying that the policymakers that were sitting in that room were very aware that there was a sense of gravity amongst them there. So they said they have their eyes on the ball, they're aware of the complexity of the moment, given, looking at markets, etc. So they're working all together. But that was basically the sense that we had from them, is like, look, we need to look at targeted support for the economy and need to be very aware of the risk on inflation.
In order to weather the impact of this crisis on growth, we need to make sure we are targeted. That means we address the most vulnerable actors that are today facing this crisis. Domestically, some households, some sectors, farming, fishing, are the most exposed, transportation is, some others are not. But also globally, we all agreed, and we've asked the IMF and the World Bank to step up their game on that front, that some countries are obviously suffering more than others. This is cropping season in Africa. We know that there's massive fertilizer issue, prices have gone up, and we're missing some. We need to make sure that we, as rich countries, are doing everything we can to help those countries that are the most vulnerable. And again, the IMF and the World Bank obviously are very aware of their mission and wanting to step up their game. So, understanding the impact on inflation, this is the monetary policy part of the story. We had a great conversation with our central bankers. They're faced with a unique situation that, negative impact on growth, positive impact on inflation.
Are you wishing for some messaging from them to kind of help, given what we see in the bond market?
No, what I felt this morning, and I'm not surprised by this, but this is very important. They have their eye on the ball, and they're aware of the complexity of the situation. In the 70s, at the end of the day, an oil shock was inflationary. There was no debate about it. In the 90s and the noughties, an oil shock was recessionary. It wasn't inflationary anymore, because at that time there was massive deflationary forces at bay. At the moment, we'll probably be in between. And the ability of central banks to monitor the situation and take the right decision at the end of the day is going to be very important. And I felt that, again, in this moment of gravity, they had their eye on the ball, they had the importance of their mission at hand. And again, this was a good day because we felt that the solemnity of the moment was in everybody's mind, and the willingness of everybody to do the right thing was also there.
Because there is a feeling for a lot of investors out there and people that watch the economy closely that we have a bit of a perfect storm forming. So you have the lasting inflationary shock pushing sovereign bond yields to decades high and rising risk to hit spending for governments, households and businesses. How concerned are you? Because even if there's a resolution tomorrow to the war in Iran, the shock will last until, a lot of say, at the end of next year at the earliest.
I mean, it's a supply-side shock, and we know the extent of it, 20% of global oil supply, 20% of liquid gas, some fertilizers or helium or others supplies that are missing. We also know that the global economy was quite resilient coming into that crisis. The IMF has told us that before this crisis, they were on the way up in terms of changing their forecast up on growth and down on inflation. So we entered this crisis quite resilient, but it's a shock. So at the end of the day, what we need to make sure is that we understand the impact we can have on those great challenges that are growth, inflation, and budgetary deficit. We need to make sure that we reassure the bond markets on the fact that we are going to do everything we can to support growth without leaving public deficit go astray, because it's not the right way of doing it. This is a supply shock. You're not going to solve a supply shock by funding demand like there's no tomorrow. Everybody's aware of that, and I think the markets should be aware of that because we're going to be serious about it.
And that was Roland Lescure, the French economy and finance minister, speaking to me yesterday at the end of the first day of this G7 meeting here of finance minister and central bank governors. Of course, all these delegations that will be joined today by extra countries, South Korea, India, Brazil, and Kenya, try to take stock, find some common ground, particularly, of course, with the US delegation, because the big risk to the economy and to prosperity to these economies were the war in Iran and, trade tariffs that were not far in the background there as well. So they will be discussing all this. We expect to communicate later this morning that the area where they might find some common ground is a question of addressing global imbalances. Basically, they sum up the situation as China under-consuming, US over-consuming, and Europe under-investing. So they want to try and address this. The question of supply chains and the reliance on China, the question of rare earth and critical materials, so to diversify the supply chains there, find toolbox to stabilize markets, have producer prices with a floor, pool purchases. So, all the sort of elements that they're looking at potentially that will be published in the communique later this morning. But certainly try to have a roadmap for the all-important leaders meeting that will be happening in Evian in just 4 weeks. So these finance ministers discussing all these issues, and we see markets starting to get nervous about the impact of the Iran war on their global economy.
Charlotte, thank you very much. And is that all-important backdrop as the G7 was meeting that the markets were seeing the sell-off in the bond markets, the yields reacting to concerns around the imbalances, the inflation story, debt loads. So we saw the escalation. Helpful overnight has been the signals sent from Donald Trump that we may see a way forward when it comes to Iran. He was effectively pausing the attack on Iran and saying there may be progress around some sort of nuclear agreement. Tehran sending a fresh proposal to the Americans. So this helped calm markets in the session this morning and across in Asia today. Oil prices have flipped lower. That has taken some of the heat out of the bond market. US markets reacting, though, yesterday. You could see it's the Dow that has been higher, 2 straight sessions firmer, but we've had a reversal for the technology names that has brought the S&P and the Nasdaq unstuck in that session yesterday. Today, the all-important act, that macro event, NVIDIA earnings after the bell. And the market is looking to see whether that AI expansion cycle is firmly on pace. So that is the big driver for the technology stocks today. In terms of Asia, picking up on some of these cues from Wall Street, this is how the trade looks across the region today. Japanese stocks are down 0.6. Heavy selling out of the Kospi, down 2.8%. We are seeing green on those markets out of China. and Hong Kong. For European futures, as we look ahead to the trading session this morning in about 45 minutes' time, we're chasing some modest green. 2/10 on the big stocks, the 50 futures, about a third on the FTSE 100 here in the UK, and a little bit less on the DAX, about 0.1% on the back of what was a pop yesterday. We were stronger across the board for European markets, about 1.5% up on the DAX. US futures early on as we gear up for that trading session. It does look cautious at this hour. The Nasdaq in particular seen down 0.4%. But I mentioned some of that backloaded action later on after the close today in terms of Nvidia. And don't forget that stock is up about 10% for the trading month.
All right, let's have a look at the epicenter of the concerns of the market. It's not coming through in currencies and barely coming through in equities, but it is in the bond markets. JGBs, which a lot of people have been focusing on, 2.8% yield there as well. The 10-year gilt of 5.1. And just to remind you, we've just had unemployment data out of the United Kingdom. Average earnings, including bonuses, slightly higher than expected at 4.1%, and the unemployment rate has ticked up to 5%. Another quick look at the 30-year paper. Let's have a quick look at that at the long end in the United States, 5.14, and the 30-year gilts trading around 5.8%. Paul Skinner is investment director at Wellington. Paul, I just made a statement. I think you will agree with it, that we're not seeing particular stress in the equity market, not seeing particular stress in the foreign exchange market, but we are seeing concerns around the bond market. Is that entirely logical given everything that's being thrown at the markets at the moment?
Absolutely. I mean, we have nominal growth that's off the scale at the moment. So it's no surprise that risk assets are doing fantastically well. The problem we have is inflation, not just because of the supply shock that's coming from Straits of Hormuz, but inflation is embedded in many of these economies. And we've got central banks that aren't necessarily stepping up and fighting it. And the problem, if you look at the spectrum of different central banks around the world, you've got the inflation fighters. ECB have said they're going to raise rates to counter the increase in inflation. SMB, probably the Bank of New Zealand as well. They're the inflation fighters. On the other side, you've got the growth protectors. Bank of Japan is one of those, and we've seen what happens when you keep rates very low and your inflation rate is now 2.5%.
Let me dust off the manual and my own dull rhetoric from 2020, 2021, where I think I had some great battles with the likes of Paul Donovan and others about whether inflation was transitory or not. It feels like I'm dusting off that manual again, and you're saying this inflation isn't transitory this time around.
Absolutely not. And, we do have momentum in many of these economies. You look at what's going on in the United States. Same-store sales up 9%. You've got, unemployment now falling down towards 4%. You've got payrolls at 75,000 a month. This is an economy that's actually going quite well. It's got momentum, and as a result, we don't just have an energy supply shock, we've got a labour supply shock. We don't have the migrants we used to have in the United States, and that's going to create inflation. We think core inflation by the end of this year in the US is going to be 3.5%. We think in headline it's going to be 4%. That's not an environment where a central bank can be leaving rates where it is or cutting them. It's an environment where a central bank needs to be raising rates. And, we've got the new chairman, Warsh, coming in. He's declared he's not going to give, forward guidance in the way they have before. Now, that might keep President Trump off his back for a while, but the truth is it's going to create more surprise for the markets when they actually do things. And that means we need to put a little bit of a premium in bonds.
Sorry, you've just told me some news there, which I didn't know. Sorry, what, we're not going to get a dot plot?
He is talking about...
As long as we've got a dot plot, we've got forward guidance.
No, but he's talking about removing that transparency going forward. That was the statement he made in the Senate. So, there's...
no summary of economic predictions. I didn't know that.
Yeah. But remember, that's like the old days when, we didn't have that forward guidance. So, in that environment, you have to expect bond yields to rise a bit, to give a bit of volatility premium. And all of that means that as we go forward, risk assets that are on this charge may well hit a bit of volatility, and that is what we're expecting in the second half of this year.
With that in mind, Paul, given the divergent outcomes that the markets are predicting, on the one hand, you've got the bond markets factoring in what they anticipate to be higher inflation and the effects of that from the energy price shock. On the other, equities keep hitting fresh all-time highs. Yeah. Do you think this leaves equities vulnerable to a sharp correction at some point? And if so, when?
That's exactly it. So we do think that leaves them vulnerable to a correction. Now, do we think that inflation is embedded for the long term? No. So this could be just a correction rather than a start of a bear market in equities. But there's going to be huge disparity across the world because of how central banks are reacting. If the central banks have been responsible and calmed inflation early, then you're going to have less of a result. What we found in the 70s is that if we let stagflation take hold, like the UK did in 74, that's catastrophic for risk assets. And that's what we want to avoid. We want to be more a 79 oil shock, which remember was Iran revolution. And there, the central banks kept rates high and we avoided that stagflationary problem. Risk assets did far better, even though they kept rates high. So, there's going to be a difference in how markets react depending on how your central bank has responded to this crisis.
And what's interesting is that there seems to be, generally speaking, for the most part, a consensus that the banks are taking a wait-and-see approach. None of them want to move too quickly. In fact, the Deputy Governor of the Bank of England just this week has said she doesn't think the bank should be too, quote, trigger-happy on rates. Do you think that caution, as it appears, may come back to bite them and feel like inaction later down the line?
That's exactly our point. We think if you're slow in responding now, it means you'll have to do more in 2027. Yeah? And so by talking hawkishly, as the ECB have done, almost straight off the bat, they will probably avoid having to do more hikes later on. And because once you let inflation get embedded, once you let it get into what we will think of what inflation should be going forward, that's what keeps it going and that's what creates an embedded.
Interestingly there, you said talking hawkishly. Is that enough without even acting hawkishly?
Well, I think the market has basically nailed on a rate increase in June from the ECB. That's probably going to happen. So, they talk hawkishly, but I think that's the direction of travel from what the market has received in terms of information.
So can I pick up on that point? Because you're saying that on the growth protection squad is the BOJ. However, that said, you've still seen JGB yields move higher as well. So the market is calling their bluff in a sense that they are now looking at the debt load and they're moving into the bond market to reprice some of the risks. So I don't think you're protected even if you're not prepared to move on interest rates. You're still getting the financial market tightening.
You're in a problem if you're with one of the growth protector central banks. And we've seen that in Japan. You've seen them having to intervene to stop the yen depreciating. Because if you've got negative real yields of about 1 3/4%, your currency is going to weaken. And so they spent $10 billion trying to stop the yen weakening. And at the same time, the yield curve steepened dramatically. 350 basis points between money market and the 30-year. The Japanese 30-year yields more than the German 30-year now. And that steepening of the yield curve clearly means that financing your deficit becomes that much more.
To me, there are the two key parts here, and that is repricing by corporates and it is higher wages. And we've been looking at the wage component this morning from the UK perspective. This is what central banks will be looking at. We are hearing a lot about repricing very quickly because of the supply chain. Wages, the missing link here. That big question mark is still dangling. Well, how do you think that plays out?
Well, we think it will come through. And we do think that demand for labour is still strong. Most people are sort of relying on an AI miracle to release labour into the web. We don't see it happening. We just simply don't see it happening. And, in the States, you've seen the hiring of young people dramatically increase and their unemployment rate fall, quite considerably. So if there's no AI miracle to release labour, we're going to see continued pressure on wages upwards, and that's going to add to this inflation pulse coming from the Straits of Hormuz.
Yeah, that is the crystal ball part for the markets, I think, when it comes to the macro. Thank you very much for that, Paul. Paul Skinner with us, Investment Director at Wellington. The IMF raised its growth outlook for the UK economy this year up to 1% from 0.8% in April. That is down, though, on the 2025 figure of 1.4%, with the IMF making clear that growth is contingent on commodity futures prices as of mid-May, and that expansion won't recover until the second half of next year. The IMF also flagged risks tied to a potential challenge against Sir Keir Starmer, warning that domestic uncertainty could hold back consumption and investment decisions.
Still to come on the show, President Trump says Gulf states convinced him to delay another wave of attacks on Iran. Dan will bring us the very latest updates from Abu Dhabi. Plus, Russia's President Putin heads to China today, less than a week after a visit by Donald Trump. We'll cross live to Elaine in Beijing. And we'll be joined by the former NATO Secretary General and Danish Prime Minister Anders Fogh Rasmussen. That conversation at 9 o'clock London time.
I'm Steve Sedgwick from CNBC, and in my new podcast, Executive Decisions, I ask powerful leaders about their decisions that changed everything.
I'm not frightened of making tough decisions, and I think leadership can be very lonely.
Business leaders should not stay quiet in a world which is super complex.
It is absolutely fine to also change your mind.
Tough calls, personal crossroads. These are the stories that we can all learn from. It's Executive Decisions from CNBC. Get it wherever you get your podcasts.
US President Donald Trump said he has postponed plans to attack Iran today after Middle East leaders, including from the UAE and Saudi Arabia, asked him to hold off. And let's get out to Dan for more. Dan, we've seen a lot of optics around the Middle East. Just to give us the latest take and what you think it means in terms of the time frame we're dealing with.
Karen, good morning. Well, President Trump says he has delayed a planned US military strike on Iran after appeals from the Gulf Arab leaders, opening what he's calling a final window now for negotiations with Tehran. This all came about in a post on Truth Social, Trump saying he had instructed the Defense Secretary Pete Hegseth and senior military officials to stand down from an attack that he claimed had been scheduled for today. But the president also warned the US military remains ready to launch what he described as a full large-scale assault on Iran at a moment's notice if diplomacy fails. Here's the president speaking earlier.
We were getting ready to do a very major attack tomorrow. I've put it off for a little while, hopefully maybe forever, but possibly for a little while, because we've had very big discussions with Iran, and we'll see what they amount to. I was asked by Saudi Arabia, Qatar, UAE, and some others if we could put it off for 2 or 3 days, a short period of time, because they think that they are getting very close to making a deal. And if we can do that where there's no nuclear weapon going into the hands of Iran, I think, and if they're satisfied, we will be probably satisfied also.
President Trump there. And according to reporting today from the Wall Street Journal, Trump made the decision after calls with the leaders of Qatar, Saudi Arabia and the UAE, who all urged him to give negotiations another chance. Trump also said the Gulf leaders told him that serious negotiations are now taking place, and also urged that a deal could still be reached that would prevent Iran from actually getting a nuclear weapon. But Gulf leaders also warned Trump that any strike on Iran could trigger retaliation against regional oil and energy infrastructure here. The White House has not necessarily released details about this planned military operation, although US officials have told Axios that the administration had grown increasingly frustrated with Iran's latest proposal and actually believed that Tehran had failed to make meaningful concessions. And this latest diplomatic push also comes after weeks of stalled negotiations following a fragile ceasefire that was announced back in April. Tehran has so far resisted the US demands to dismantle key parts of its nuclear program and fully reopen the Strait of Hormuz, which has, of course, also kept oil prices well bid over the last couple of weeks.